Howdy everybody, welcome back to BFI. I'm Professor Martin. In our video today, we have a really interesting topic. We're talking a little bit of theory on the stock market. We're going to talk about stock market efficiency. So we're going to jump right into it here and start off by talking a little bit about Coke. And we talked in our previous video about how to read a stock quote. So here we have that stock quote for Coca-Cola Company. And we can see right here that stock was trading for $59.72 a share. That's the market price. But how much is Coke really worth? If we want to buy a share of Coke, we're going to pay $59.72. But what is that share really worth? That idea is called intrinsic value, and it's a company's true value. How much a stock would trade for or sell for if all the information about that stock were perfect and it were publicly known. The intrinsic value is just an estimate. Because we obviously can't know all the information out there and it's not perfect information anyway, we can't know for sure. So we have to make an estimate. And everybody that looks at it might make a different estimate. When analysts try to decide how much a company's worth, when they're trying to determine their intrinsic value, three analysts might all come up with a different conclusion. Okay, so we have the market value, the price that a participant in the stock market is going to pay to acquire a share of stock or to sell a stock at. And then we have the underlying intrinsic value, a hypothetical estimate as to what that stock is really worth. And both of these are in play here. I'm kind of show you a little graph here. This is a graph of a hypothetical stock, the actual price versus the intrinsic value. We see the actual price represented by the green line. The blue line is our intrinsic value. So what happens when we have a stock trading here on the market, but the intrinsic value is a little bit higher? We can say that stock is undervalued. It might be trading for 10, but it's really worth 15. It's undervalued. The flip side of that coin, if we look right here, our stock price is higher than the intrinsic value. We say that stock is overvalued. It's selling on the market for 30, but it's only really worth 20. All right? So we have market value and we have intrinsic value. We have an efficient market when the market price and the intrinsic value are pretty close together. There's not a great big gap. There's not great big swings between undervalued and overvalued. There's a pretty narrow window. When that happens, when a stock trades on the market for what it's pretty much close worth as far as its intrinsic value, that's an efficient market. So that leads us to this idea of the efficient market theory, that all the existing information about a company is really already baked into the stock price. All right? And because of that, the asset price is going to be pretty much equal to its intrinsic value. Maybe a little bit higher, maybe a little bit lower, but there's going to be a pretty narrow window there. I'll give you an example. And sometimes I hear people say things like, in September, I'm going to buy stock in Hershey's company because Halloween's coming up. Well, yeah, everybody already knows that. It's already baked into the stock price. Here we have Walt Disney Company. Everybody's familiar with Walt Disney Company. Right now it's trading for about $90 a share. That's the market value. But if you look at it and you study a little bit, you may say, well, wait a second. Oh, I'm onto something here because Walt Disney is celebrating the 100th anniversary of the company. They're going to have all kinds of stuff at the theme parks, limited edition hoodies, snacks, souvenirs. Everybody's going to be flocking to the Walt Disney World theme parks to celebrate a 100th anniversary. Well, yeah, okay. That's known. It's not a surprise. Everybody already knows that. It's baked into the stock price. And you say, well, what about this? Over break, I had a lot of time on my hands because I wasn't studying for classes. So I subscribed to Disney Plus. Man, they've got every Star Wars movie. They've got all the animated films. They've got all kinds of TV shows on there. All this great stuff that I watched when I was a kid is on Disney Plus now. So these boomers and these Generation X people are going to be flocking to Disney Plus and paying $20 a month. They're going to make a ton of money. Okay, yeah, you may be right, but guess what? Everybody already knows that. It's baked into the price of the stock already because that's common knowledge. And you say, well, okay, well now, what about this, Martin? The other day I saw an article. Apparently, Mickey Mouse is coming off copyright. And you can take Mickey Mouse and draw that character and do anything you want with it. And I saw where a movie studio was going to make a horror movie. Mickey Mouse is going to be out there gutting people. Oh, it's going to be horrible for the Disney brand. It's going to kill their stock price. I'm not saying you're wrong. What I'm saying, and you guessed it already, it's already baked in. Now, if tomorrow at Magic Kingdom, Space Mountain goes flying off its tracks, the ride, and a bunch of people get hurt and 50 people get hurt and the news is there and they find out that Disney has been skimping on maintenance and they falsified maintenance logs and it's a big deal. New information comes out, sure. That could really hurt the stock price because that is new information that wasn't known before. But for the most part, information that is out there is already baked into the stock price. So if you're trying to get ahead of the game by using information that's publicly available, you're not going to be ahead of the game. One of the things I like to do when I'm looking at the stock pages every day on Yahoo Finance, I like to look at the gainers and the percentage losers on that particular day. You can see some interesting stuff there. So yesterday, as I was grabbing stock quotes, I noticed we have Cytokinetics Incorporated down 24%. Some new information must have come on board because remember, the efficient market theory says that there really shouldn't be great big swings in percentages because all the information is already out there. It's baked in. Down 24%. So what happened at Cytokinetics to make it drop 24% in one day? Well, Cytokinetics is a pharmaceutical company. Novartis, a bigger pharmaceutical company, has been sniffing around, thinking about buying Cytokinetics. When that news broke, Cytokinetics stock went up because I thought they were going to get bought out. Then, yesterday, Novartis backed out of the deal. No longer interested in buying Cytokinetics. Look at the stock price, 24%. New information has come online. So a lot of times when you look at the percentage gainers and losers on any given day, they're there because some great big piece of news has broken. And the investing community is trying to basically digest that news and decide what to do. In this case, sell off the stock because it's not going to get bought out. So we have an idea of an efficiency continuum. We have the efficient market theory, and there's kind of a continuum along that theory. We're talking about highly efficient markets. We're talking about large companies like Disney, Coke, Walmart, followed by many, many analysts, 30 or 40 analysts covering it, watching it, looking at what's going on. The companies communicate with investors very well. They release a lot of reports, a lot of PR, financial statements, correct, all that good stuff. Information is there, highly efficient. That gap between the market value and intrinsic value is going to be pretty small. We move down the line here to highly inefficient. Then we're talking about small companies. Not many people follow them. Not a lot of information going out to the investing public. Those are going to have a little bit bigger of a gap between the market value and the intrinsic value. And so when we talk about a bigger company, when some kind of big piece of news breaks, it moves more down towards the continuum of inefficient until the investing community has digested that news and baked it into the stock price. So, efficient market theory, hypothesis, assumes that investors are rational. Investors are rational. What do I mean by that? Well, first of all, it assumes that they will buy when a stock price is too low. It assumes that investors are there to make money and they're looking at the information. If a stock price is undervalued relative to the intrinsic value, they will buy up that stock and make money because that is the rational thing to do. On the flip side of that coin, they'll look at it when a stock has gotten too high, the market price is well above the intrinsic value, they'll sell it off and take their profits. A rational investor does both of those. They buy low, and then they sell when the price gets high. Because investors are rational, the market prices are never going to deviate too far from intrinsic values. Prices are never going to get really, really far out of whack. They just can't. That is the efficient market theory. The key word there, y'all, being theory. It's a model. It's a theory of how the world works. You've been around enough to know the model and theory of how things work is always nice and clean. It's a bright, sunny day on an island somewhere where everything works perfectly and everything hums along according to plan. That's how models and theories operate, right? But we know in real life, the models never work like that. They look more like Elmo here. Everything's on fire. Everything's chaos 24/7. That's the real world. So we have a hypothetical efficient market theory where everything's nice and neat and everybody's rational and the information's out there and prices kind of magically adjust accordingly to the information comes out. That's the theory. In real life, it's not always that clean. Things catch on fire. People freak out. I'll give you a few examples of why, or I should say criticism of the efficient market theory. First of all, it depends on rational investors, right? Your rational investor is an idiot. If you've ever been on Reddit, on the subreddit Wall Street Bets, and read for even 5 minutes, you'll see a lot of investors out there are just pretty crazy. This is a post a few days ago from the user I Miss Your Mommy. Username checks out. Last night I had a vivid dream where I met up with an old friend. And they mentioned some material information on Target in the dream. I woke up wondering if I had some divine inspiration. Should I buy Target? Would you trust a dream? People are literally buying stocks from tips that came to them in a dream. I bought shares of Jones & Soda last term because my Accounting 1102 class told me to. And so now I'm the proud owner of 250 shares of Jones & Soda, but for no other reason than as part of a class discussion board. And so investors aren't always really rational. Wall Street Bets has been home to all kinds of stunk happenings over the past couple of years. GameStop, AMC, and made a lot of money, but they've also lost a lot of money. So they're not exactly really analyzing things here. They're just kind of wildcatting it. Gambling, if you will. And so your rational investor can be an idiot. Sometimes your rational investor is afraid. We're looking at the S&P between 2018 and right now. And you'll probably remember March of 2020, COVID. All the COVID restrictions started coming out. Businesses were forced to close by local and federal authorities. And you can kind of see that right there in February. We're close to 3,500 and the Dow dropped to below 2,500 within a week. Man, buying opportunity, right? If you're looking at the market in March of 2020, stocks were on sale, 50% off. Walmart, Target, Netflix, Amazon, all these big names went down 25, 30, 40, 50% in the month of March of 2020. You could have taken a stock page out of the Wall Street Journal, tacked it on your office wall and threw a dart at it. And whatever you hit, bought it. And you would have made really good money between 2020 and 2022. Just random. And you're sitting there looking at it. You know that things are oversold. I knew it. I knew in 2020, I was like, this is overdone. These companies are being way oversold. I knew you could make some money in that. But I was afraid. If I lose my job, if my wife loses her job and I put all the money in the stock market, we don't have any cash on hand. Can't pay the mortgage. Had a professor in college. One of the first pieces of investing advice I ever got. Martin, you can't live in a stock certificate. And that kept going through my mind. If I put too much money on the table and the market doesn't turn around quick enough and something happens with our employment, I'm going to be hurting. I was afraid to put that money on the table. Even though as a rational investor, I knew that the market was oversold, still couldn't pull the trigger. Same thing happened in 2008 with the Great Recession. Same thing happened in 2001 after 9/11. Just couldn't quite bring myself to put more chips on the table. Dang it, I was afraid. Your rational investor is also overconfident at times. I suffer from something called self-attribution bias. Self-attribution bias is the idea that when you win, it's because you're a genius. You made all the right moves, you smarty. You're just better than all these other chumps that are out there losing money all the time. And so let's take that scenario in March of 2020. I start to put some money in the market. I do nothing but win for 2 years. I can't lose. The market just keeps going up and up and up and up. I am a genius. So what do? Put all my chips on the table. Never mind the fact that everybody else is making just as much money as I am. Not really anything special, but in my mind, I've made all this money because I'm good at investing. I'm a champion. Put my chips on the table. Then what happens in 2022? Well, the market starts to come down. I lost. But in self-attribution bias, we take credit for the gains, but we don't take credit for the losses. We say, well, I lost because the world hates me. The market's rigged. It's those dang Democrats. It's those dang Republicans. It's their fault that I lost all this money. It's not me. I made the right moves because I'm great. I made all that money between 2020 and 2022. Can't be me. So the self-attribution bias, we get overconfident and we gamble a little bit more than maybe we should. The more gains we have, the more likely we are to gamble. Go to Wall Street Bets on Reddit. You'll see it. You'll see one post at the beginning of the year. I made $3,000 on this trade. Then 8 months later, well, I lost $30,000. It's wild. We also have a hindsight bias, a tendency of people to believe that after an event has happened, they predicted it before the event happened. You start to become a little bit overconfident in your ability to predict the future, which no one can do. You may have noticed I suffer from a little bit of hindsight bias. All these times the market's crashed, I kind of stayed on the sideline. What's going to happen the next time the market crashes? Well, I'm going to think, I knew this would happen the last 3 times, that the market would shoot right back up. So based on that, I predicted it before, I'm going to get into it. I'm going to throw some more money into it. I'm assuming that just because it happened before, it's going to happen again. Because I think that I predicted it. But nobody has a crystal ball, right? Nobody does. So we have a little hindsight bias there. So in conclusion, if the stock market is perfectly efficient market theory holds, then stock prices really reflect all the information that's out there. And you can only really win if you're lucky, like you're maybe in Walt Disney World when Space Mountain goes off the tracks and you get on your phone and buy puts right away or sell the stock right away before the price goes down. You can win if you're lucky or if you have insider information. If the stock market is perfectly efficient. That's the only way you can really win. And so under that idea, analyzing stocks is just a waste of time. All the information's out there. There's no bargains to be had. You might as well just buy an index fund and be done with it, because there's no point in trying to find a bargain because it doesn't exist. But we know that inefficiencies do exist. There's information deficiencies. There are irrational investors out there who do dumb things. As such, if we really want to, we can seek out undervalued companies. Now, where that's going, we'll talk about building portfolios and we'll talk about diversification and all that stuff a little bit later on. And not to say that picking individual stocks is the right way to go. The index fund probably still is our safest and best bet for long-term gains, especially if we're trying to avoid big-time losses. So we'll get into all that a little bit later on. But the efficient market theory, a fun little walk down a little bit of stock theory today. If you have any questions about that, I'd be happy to chat. You'll see a little bit of that on your homework for the week. If you have any questions in your homework, feel free to throw those at me as well. Until next time, take care, everybody.